This is Ryan Coombs, Vice President of Research and Strategies at Carty & Company. Here's your weekly market update ending the first Friday of March 2016. In the economy, employers added more workers in February than projected, but wages unexpectedly declined. The gain of 242,000 new jobs followed a 172,000 rise in January. That was larger than previously estimated, a Labor Department report showed on Friday. Average hourly earnings dropped, the first monthly decline in more than a year, and workers put in fewer hours. While the U.S. unemployment rate held steady at 4.9% in February, the unemployment to population ratio shrank by the most since October 2014, narrowing a gap that has persisted since the Great Recession. The 0.2% decline in the share of all working-age Americans without a job shows that a strengthening economy is chipping away at spare capacity in the labor market. The workforce participation rate has now risen for 3 straight months, reinforcing the trend. The U.S. trade deficit widened more than forecast in January as exports slumped to the lowest level in more than 4 years. The gap grew 2.2% to $45.7 billion, exceeding all forecasts in a Bloomberg survey of economists. This is the largest gap in 5 months. Demand from American consumers will be needed to pick up the slack, putting even more importance on an improving labor market that translates into real wage growth. Treasuries experienced their 3rd weekly loss in a row. U.S. government securities have fallen nearly 1% based on the Bloomberg U.S. Treasury Bond Index. A flight to quality that sent investors rushing to treasuries earlier this year is easing. That is allowing traders to focus on the economy, where the latest data is showing improvement from manufacturing to employment. The yield on the 2-year note, the security most sensitive to Fed policy expectations, rose 3 basis points to 0.87%, the highest since January 27th. The gap between yields on the 10-year Treasury note and the equivalent inflation index securities, known as the break-even rate, reached the most in 2 months. This suggests prices will rise at an average annual pace of 1.54% over the next decade. The market puts the probability of a Fed rate increase by December at nearly 70%, futures data compiled by Bloomberg indicates. The figure has climbed from as low as 11% in February. The equities markets rose for a 4th day on Friday, the longest such rally since October. Investors are shaking off data showing a decline in wages to focus on a surge in hiring that's bolstered optimism that the economy can weather a global slowdown. The S&P 500 climbed 0.3% to 2,000, capping a 3rd week of gains, the best such stretch of this year. The index has rebounded 9.3% from a February 11 low, as banks and consumer companies climbed, though the gains have come amid the weakest volume in 2016. Improving economic data and stabilizing oil prices have helped support the rebound. Along with speculation, the central banks will continue to provide stimulus. Signs of inflation gaining traction should be noted, and if it continues, will temper market optimism. That sums up your weekly market update ending the first Friday of March 2016. For more details, please visit our information center at www.cartyco.com, and for real-time updates, follow us on Twitter at Fixed Incomes. Thanks for watching and have a great week.